Well, good morning, everyone. Thanks for joining us. Today, we're going to be talking about deferred comp in M&A transactions. We're going to get into the various documents and provisions that are typically impacted in acquisitions, how those items are affected, and any potential tax impacts. My name is Scott Richter, and I'm a partner on the Williams Mullen M&A practice team, and I lead the firm's community banking initiative. Joining me today is Nona Massengill, my colleague and partner in the Employee Benefits and Executive Compensation Group. Nona's practice focuses on a wide range of employee benefits matters with an emphasis on executive and non-qualified deferred comp and equity-based awards. She helps publicly traded and closely held employers alike, and also tax-exempt entities and executives with tax, fiduciary, and business aspects of employee benefits, employment agreements, and severance arrangements. One area that I routinely seek Nona's guidance on for transaction is deferred compensation. In my M&A practice, the issue comes up in almost every deal. Nona has a great deal of experience with deferred comp in M&A settings, and today we thought we'd just have a brief discussion on it and touch upon some of the more significant considerations in those transactions. But before we kick off our program, I've got a few housekeeping items to go over. First, you can submit any questions by using the Q&A button at the bottom of your screen. We'll turn to questions at the end of the presentation. If you're having any kind of audio or other technical problems, please use that same Q&A button, and our marketing folks will work to get those resolved. And then finally, we're going to send everybody by email the presentation today, so there's no need to write down the information that's being presented on the slide deck. You'll get those later today. So let's get started. Nona, thanks again for joining us.
Sure.
Why don't we just give everybody just a quick overview of what we are talking about when we say deferred compensation?
Yeah, it's really important to realize that it is a very broad definition. On a basic level, it's comp that's payable over a period of years or at some future specified time or event. That specified time might be retirement, it might be a fixed date, and very often it's a change of control or other transaction. There are many types of deferred compensation, but I would say some of the most typical and the ones that we encounter a lot are traditional non-qualified retirement plans, transaction-based bonuses, and sometimes equity compensation, and then also severance compensation that may be payable other than in a lump sum or may have been promised in an employment agreement that was put in place many years before the transaction.
Is deferred comp related to any specific industry, or do you see it more often in like manufacturing or e-commerce? What do you typically see with in terms of just focusing on particular industries?
Yeah, I mean, it certainly is across the board, but different types may be more prevalent in a particular industry. So I would say tech companies, high growth, pharmaceutical, and really any type of company that has private equity investment is likely to be focused on transaction-based and exit-based incentives. This is very common. And so sometimes you'll see equity that also has a deferred comp element, and other times it's a transaction bonus. Financial and professional services, banking, as we deal with a lot, large retail, manufacturing, and just generally more mature companies have what I would call more traditional deferred comp, and they also are more likely to have employment agreements or change of control agreements, formal agreements that will have a deferred comp element.
Got it. Well, thanks, Nona.
Mhm.
Well, I mean, really, no matter the industry, it's a good idea to consider the impact of deferred comp on a transaction well ahead of any particular negotiations. Of course, if you're on the sell side, plans or other type of agreements that contain deferred comp components are incredibly important as they impact what executive or other senior officers personally may receive as a result of a change in control and a potential, resulting loss of employment. This morning, why don't we touch upon just a few reasons why folks should plan ahead of the transaction. And the first is just, corporate governance, getting your company's act together as far as knowing the impact that your material contracts have on the organization is just good corporate practice. It's the smart thing to do. And not only is it, good to get those contracts with respect to deferred compensation settled in your mind as to what the impact is, but also, any kind of other material contract vendors alike. But today we're focusing on the deferred comp aspects of it. You can also identify any potential snags or stumbling blocks in agreements or plans long before the movement of a deal is in action and you're kind of in the heat of the battle. While things are calm, you can kind of address those while you're in the normal course of business. And confidentiality is also important. You may need input from several departments, getting information from them. When asking them for information, it seems to us is a smarter way to approach, analyzing the deferred comp impact on your organization because, it kind of sets the tone that these requests to those departments are normal course and routine and, kind of lowers the possibility that employees are recognizing that a deal is in the works and, and potential leaks with respect to a transaction. So, doing that when things are just, run of the mill is probably a good idea. And I mentioned, identifying any, potential issues before due diligence. Anything else to add there?
Yeah, definitely. I agree with all the points that you raised. It's much easier to get into the specifics, request documents, all of that type of thing, again, before a transaction is imminent. However, at any point, there are corrections that can be helpful. On the tax side, I would say that there are, we'll talk about some of the tax rules more specifically later, but sometimes those rules really are complicated and perhaps the documents don't reflect the ideal way to comply. And so amendments, pre-closing amendments are very common. I know we've seen that in certain situations, and those amendments can be done often most advantageously in any calendar year that is prior to the calendar year of close. So whether it's early on, in a transaction where one is starting to be discussed, or just in the normal course, which would be ideal, that's something that both takes a little bit of time to get those corrections done, and also, like I said, can have the best result. So I would just echo everything you said, but as well emphasize the prior calendar year concept.
Absolutely. Well, why don't we turn to some of those specific agreements and plans or programs that you typically see in a deferred comp setting? Are some more easily reviewable from a legal or financial planning perspective? Do others take time? You touch upon maybe the reasons why some take longer than others to review in connection with the transaction. I think that would be helpful for the folks to listen to.
So employment and change of control agreements, we note on the slide that they can be surprisingly complicated. And this is because they often provide for different rights in different circumstances. Somebody might terminate, you know, voluntarily and get nothing. Somebody may terminate for good reason and get, you know, a full severance. And so it's really important to understand those different circumstances and really look at the definitions, study the definitions. You know, first of all, has a, you know, is the transaction being considered likely to um, be covered by the change of control definition in the document? That's not always obvious. What does a change of control, I'm sorry, what does a good reason trigger involve? And how will, say, the post-closing or combined organization structure for key officers, you know, interplay with that good reason definition? Is it going to be triggered or not? And, you know, that can be a really important thing to know ahead of time. Equity-based promises are another type of award that it's important to be, you know, really clear on. A buyer is certainly going to find this to be essential because it's going to be key for the buyer to know, you know, what does the cap table look like? Who has phantom awards that are just settlable in cash? Who actually has a claim to something that, you know, either by design or, you know, hopefully not, but potentially inadvertently would consist of equity. So those are very important to run to ground, you know, at the outset, and of course at any time in advance, if possible. Um, Also, I will say that the equity awards often vest, you know, solely on the closing itself, and so not to say that folks don't have any right prior to closing, but there's more room to amend or correct prior to vesting with those awards. So
Mhm.
that's one consideration. Um,
Yeah. One thing you know I'll bring up is for everybody is um, you know we often see in transactions ambiguity in contracts, um, um, and sometimes you know what does it mean to have that post-transaction employment? What does it mean to have that position and title and any kind of responsibilities? It's you know, take a look at, you know, for folks in the webinar, take a look at your agreements and really read those provisions carefully in terms of the change of control and any kind of post-change of control um, um, employment aspects to it. Make sure there's no ambiguity. You know, try to get clarity on that up front. If you read it and think about things when you're not in the middle of a transaction, that you can read it carefully and think about what does this mean to you. And if you can't, think about different scenarios. You know, if you're the CEO, but now you become a COO, how are you covered during these particular contracts? You know, different if you're moving up and down a ladder with respect to executives. How does it impact me, and what does it say in my change of control agreement or employment arrangements or other, you know, deferred comp plans or programs? What does it mean specifically to me? Because it does come up from time to time that there's a little bit of ambiguity. Well, also, you know, you and I work together on a ton of transactions, and you know, we all know that the SERPs can get really, really complicated. Can you explain what the type of plan that is and what to look out for?
yeah, of course. So a SERP, you know, is an acronym, but it's basically a plan that's a supplemental executive retirement plan, a type of non-qualified deferred compensation plan. It's usually a fairly formal plan document, and it's in the defined benefit category of plan, meaning that the benefit promise is described and defined. And this is in contrast to a plan where either the employer or employee makes principal contributions, deferrals, and there's an interest rate, you know, return that just sort of sets up an account balance. SERPs are 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 different, and they're often company specific. So no two benefit formulas are the same, exactly the same in my experience. There can be final average pay formulas with various offsets. And so because they're individualized and a little bit more complicated certainly more complicated than account balance plan, that takes a bit of time. They often pay out for many years post-retirement. They often call for the parties to put contributions into a rabbi trust at, say, for example, certainly in the context of a transaction is the most common event where you would have to fund up those plans. Um, Sometimes they're backed with insurance or have an insurance policy as you know as a formula measure, um, and and so even if you understand the document and both parties are on board with what it says, sometimes the buyer or perhaps the seller, but more often the buyer just says, we don't want to administer this for the next 15 to 20 years. Let's just terminate it. Can we do that? And then we get into some of the tax issues where
Mhm.
it's can be done. It can be done, but it's not just a matter of, it's not just a business decision. It's a business and tax decision, and have to jump through the hoops. So um,
Yeah.
yeah,
Yeah.
uh,
Touching upon the tax issues, maybe we can salute the fact that, we can go over with people what are the tax provisions.
mhm.
Um, on the 409A and there's another provision, 280G. Can you just run through those for a sec?
Of course. So 409A is one of the, it's always in the mix when you have any type of deferred compensation. And this is a code section that limits when and on what events you can pay deferred compensation. And it also limits the ability of the employer, certainly the employee, but also the employer to change the payment timing. And so just, per the last slide, if the parties for very valid non-tax business operational reasons want to alter the terms of an existing plan or agreement, that can be complicated. It has to, well, it's not that complicated, but it has to be done carefully, in order to make
Mhm.
sure that the 409A exceptions for changes in the context of a transaction are observed. So, um, that's one thing that is really relevant in the context of a transaction with respect to 409A. Another aspect is to, if a 409A exception is available, that gives the parties more flexibility. So that's one significant code section that we always deal with.
Okay. Well, I mean, 409A is incredibly broad based. So, and I think, hopefully most folks on here are at least recognizing or have heard of 409A before. So, um, pretty familiar. Are there any kind of ways that you can address the 409A's impact on a transaction, or talk about what happens if the 409A is not observed?
Sure. Um, so it's definitely not just a theoretical concern. There are tax penalties, and they're significant. You know, just at a threshold, it's 20% of the amount involved, and that can be up to the entire plan benefit. Um, and the penalties fall primarily on the executive, but you know, no employer or certainly acquirer wants key employees to have some tax risk hanging out there. So it's
Mhm.
practically speaking, affects not just the executive. And then there are also correction. So you mentioned mitigation. I mean, there are correction methods, and there are informal and formal corrections. Even the formal corrections are, you don't have to wait for approval. You just prepare the documents and file them. And many times in transactions, either officers counsel or buyers counsel, insists, or sellers counsel said, hey, we recognize that this is out there, and just to be, careful, we're going to do this correction. So it's common and it's good practice to vet the documents and see if a correction can be done.
Got it. Thanks. Well, another tax code provision that we often deal with is 280G, and those golden parachute rules. Can you just give a rundown of 280G?
Yeah. So 280G is this is really just, and most folks are probably generally familiar with it, but it's a statutory cap essentially on payments or payment enhancements that can be conferred in the context of a transaction. So certainly closing bonuses, accelerated vesting of equity awards, that's very common. Accelerated vesting in a SERP. Severance payments if the termination is in connection with, sort of a broad definition of in connection with a change of control. Many types of payments are considered parachute payments that have to be weighed sort of in one column against historic compensation over the 5 years preceding the change of control year to see whether this threshold is exceeded. And what happens if the threshold is exceeded is that much more than just the excess is subject to tax penalties. Again, 20% excise tax on the affected officer and non-deductibility for the company. So, it's not a good result.
Yeah, those are pretty dire consequences for folks to find themselves in. In your practice, how have you helped folks to try to mitigate those potential, tax impact and loss of deduction?
Sure. So one, very common strategy, and it can help to a degree, is to increase compensation in the pre-change of control measurement period. So if you can raise sort of average compensation outside of the change of control, then you have more to work with in terms of parachute payments. And usually this is done by accelerating or just paying in a prior year something that would be paid anyway. Non-compete obligations can be valued because they can serve as an offset to parachute compensation. And there's also, for closely held companies, there's a big opportunity to take advantage of some exceptions and special voting approvals under 280G. So, in a non-closely held company, that's not available in a closely held company. And we're really, it's feasible, and buyers really are on the lookout for companies to take advantage of this shareholder vote and approval exception if it's a possibility. So people, sometimes you see this in transaction agreements, and occasionally in the employment agreements themselves, but it's another process that can help.
Thanks. those tax code, well, any tax code revision can get super complicated, and I think, if you're a business owner or part of senior management, unless you've got a really good take on those tax code sections, it's wise to at least have somebody take a look at it, and in terms of the impact that those provisions can have on your organization, especially if you're on the selling side, it can get really complicated. Well, we're almost approaching the time allotted. Maybe we can go to the next slide and just talk about, we've already addressed kind of the 4NA, 280G, and the planning. Is there anything else, Nona, that you'd like to mention to the folks here today?
Yeah, I guess I would like to just, emphasize that buyers and sellers can both have a hand in the process, and that, as much as we've talked about advanced planning and, sort of a pre-transaction checkup of these documents, realistically, most planning does occur when a deal is being considered, and that is okay. I definitely want participants to know that it can still be done. Both the formal corrections as well as just tax planning, and it's common, and as long as people take a look carefully at the document terms before closing, usually we can help.
Yeah. Well, thanks, Nona. This has been great. I think we've got time for a few questions. I know that we've got one that's popped up, and this relates to options. And the question is, what options are available for S corporations, and kind of what about unpaid salary, quote unquote, sweat equity?
Mm-hmm. Well, so I think there you're going to be looking both at 409A and 280G. If you do have an S corporation, that is a very big exception to 280G, and certainly to the extent that at the time or immediately prior to the transaction that status applies, 280G would not be a consideration. Of course, this should be vetted, but that's a great exception. 409A always needs to be taken into account, because let's say there isn't, you're talking about unpaid or delayed or deferred salary. It's just important to make sure that there actually isn't a pre-existing contractual binding promise that is being altered at the time of the transaction. So there are a lot of ways to handle that, but we just want to be observant of anything that was already out there.
Okay. Well, thanks. Another question, and it's, are nonprofits limited in the type or amount that can be placed into deferred comp?
They can be, yes. So there are specific rules about compensation for executives of nonprofits, and those we haven't really gone there today, but certainly I've worked within those rules before, and so those are kind of the general nonprofit rules that have to be taken into account for reasonable compensation or non-excessive compensation. But then 409A and kind of a counterpart to 409A in the nonprofit world, 457F, those have to be taken into account kind of in the same way that we've already discussed about not making significant changes to the timing of compensation without running those rules to ground.
Well, thanks, Nona. I think that's it for the questions, and it looks like we're kind of at the end of the half hour. I wanted to thank everybody for attending today's program, and I wish everybody have a great Tuesday. Thanks so much.